Well, the financial market turbulence in January means we've put a lot of scrutiny on our economic view. We find that the fundamentals are actually a little changed over the past couple of months. The world economy is still on track to deliver another 3.5% growth year, which is where it's been for the past 4 or 5 years. China remains the biggest risk, but here we can see that the growth slowdown has come a long way over the past 4 or 5 years, and the economy is transitioning to a domestically driven but slower growth path. I think it's still the biggest risk in the world economy, largely because they need to find a way of dealing with their credit bubble. But if they can do that and if they can transition, then I think China should be okay. Developed economies look fine. The lower oil price, of course, is going to help, and you can see that the US consumer grew at the fastest pace in a decade last year. Of course, job growth is helping as well. And in the background, we have the central banks prepared to give support if necessary, and we saw that from the Bank of Japan and from the European Central Bank. So we find that the overall outlook for the global economy is not particularly impressive, but it's not all that worrying either. We think it's on track for another solid 3.5% type of year.
The title of our February monthly investment guide is Swing Low, Reach High. In our last publication entitled Swinging Onto Higher Ground, we laid out the market roadmap for the whole of 2016, in which we said that stock markets will gyrate in a broad trading range with higher volatility, not dissimilar to past market cycles when the Fed was raising interest rates. January's sell-off in equities certainly sits into this roadmap, albeit the magnitude of the fall and the timing was larger and earlier than many expected. Market uncertainty intensified as the world economy faces 3 big transitions, namely a slowing China, a new normal in the price of oil, and the end of zero interest rates. Clearly, China is decelerating from the double-digit growth rates of the past decade. The rebalancing of China's economy from investment-led to consumer-driven has evidently led to a slower growth trajectory, which is a headwind for markets in the short term. However, such a transition is a long-term positive, as growth going forward will be less volatile and more sustainable. Risk assets like equities and corporate bonds have been spooked by the speed and magnitude of fall in the oil price. Over the medium term, we believe the adjustment of demand and supply dynamics will usher in a more stable oil market and correspondingly financial markets, as the world economy adapts to this transition towards a new normal in the price of oil. The first rate hike by the Federal Reserve in December 2015 marks an end to the ever more stimulus since the Great Financial Crisis in 2008. Past market cycles have shown that the beginning of a rate hike cycle is normally a headwind for markets initially, but over a medium term, risk assets would rebound from the initial sell-off. After all, when central banks raise rates, it is always for the reason that the economic recovery is on a firmer footing. We believe world equities are today nearer the bottom of this broad trading range we painted for 2016. As a result, we upgrade our tactical call on equities to overweight from a neutral weighting. For bonds, we continue to hold an overweight stance in emerging market high-yield bonds, as this asset class would provide the yield carry, at the same time less sensitive to rising interest rates compared to high-grade bonds.